When it comes to financial planning, one of the most important concerns is taxation. Before we dive into financial planning or investment concepts, let's first discuss taxes and its terminology. Some of these you may have been familiar with, but bear with me as I think it is important to make sure you understand all types of taxation in order to plan properly. All of us have experienced this kind of tax when we purchase goods or services. It is a state tax and sometimes combined with local city tax and imposed in most states and countries when you purchase products. The amount of tax usually is in percentage based on the total product purchased, though depending on the state, some goods and products are exempted from taxation. For example, in San Diego County, our retail tax in 2022 is 7.75%, of which 6% is imposed by the state and the rest are charged by the local government. Since this type of tax is set for many of us since the day we were born, many times we just accept it and pay the price. However, when purchasing a big-ticket item, it may be prudent to not only shop for lower prices, but it is also for tax savings. For people who are fortunate enough to live next to a state that has lower or no sales tax, it may be worth their while to drive across the border to enjoy some of their tax discounts. If you work, most likely you have had the experience of paying this type of tax. That is considered active income. However, there is also passive income earned, such as income from rental properties that can be taxed. These are taxes at the federal level as well as the state level. Not all states impose income taxes, and even in states where there is income tax, the rate can vary state by state. This type of tax is used to fund public services, pay government obligations, and provide goods for the public. Our current income tax is a progressive system where the higher your income, the more taxes you will pay. Tax rates increase in increment, starting with a base and goes to a higher rate as you pass through a certain threshold. There are also exemptions that an individual can take advantage of, so not all income is taxed. Though most people accept that these taxes cannot be avoided, there are strategies that can help minimize how much you pay in taxes, such as contribution to a tax-qualified retirement plan to delay paying taxes. Some people may also choose not to take on additional work or receive a certain payout for their investments if the income would push them into a different income tax bracket. Capital gain tax is levied on investment when it is sold. There are long-term and short-term capital gains based on how long the investment was held. This tax can be levied on investment properties such as single-home rentals, apartments, but can also be on properties such as jewelry, arts, and other collectibles, or on securities such as stocks, bonds, etc. Long-term capital gains are for investment that are held 1 year or longer and can be lower than ordinary income rate for many people. Depending on the person's income, this rate can be anywhere from 0 to 15 and up to 20% in 2022. For investments held under a year, the tax is called short-term capital gain and is similar to that of ordinary income tax. Understanding this type of taxation is important, as choosing to liquidate an investment between December 30th or January 1st can save or cost the taxpayer thousands of dollars. Property tax generally is a local tax, though it is also levied at the state level in some states. This tax is charged to real estate owners, which include both land and property. It is a source of income for local government, and many school districts rely heavily on it for their operation. When purchasing real estate, these types of taxes really need to be taken into consideration, as it can be a substantial amount for the property owner. For example, if you are investing and want to maximize your return on investment, you may want to purchase in a location where there are no Mello-Roos, a type of tax included in property tax and imposed for the development of a community. These taxes tend to be placed on a newly built community and can last between 20 to 30 years. Even for a permanent residence, this expense needs to be taken into consideration as it is a long-term expenditure. Gift tax is a federal tax and is levied when assets or property are transferred from one individual to another without equivalent value being returned. This type of tax can range from 18 to 40% and was created so that income tax is not avoided. There is an annual and lifetime exemptions before taxes are charged. For example, in 2022, the annual exemption is $16,000 and the lifetime is $12.06 million. I know that sounds confusing, so here's how it works. A person can be gifted up to $16,000 without any taxation, but when it goes over this amount, there are potential tax consequences. When a gift occurs, an IRS Form 709 is filed, and though payment for the tax may not be required right away, that amount is accumulated, and if the donor ever gives more than $12.06 million to that one individual, the taxation will need to be paid. The gift tax tends to be imposed on the donor, not the person receiving the gift. There are some exceptions to these taxes, which include spouses, political contributions, nonprofit organizations, and direct payment to medical or educational institutions. Gift tax can be complex, and consultation with a tax professional may be prudent before a person makes a substantial gift. Estate tax is a federal tax, though some states also have their own estate tax and is levied for the transfer of assets upon death based on the total value of the estate. This tax is charged above a certain exemption amount, and some assets may be exempt from the total calculation. In 2022, for example, the exemption is $12.06 million, or double that amount per couple. If the asset of the deceased is over this threshold, the tax is calculated based on an increasing scale. For example, at $10,000 over the exemption amount, the tax charge may be at 18%, then increasing at a certain increment until it reaches over $1 million, where it will flatten out at 40%. Outside of the exemption amount, estate tax is also exempted for certain individuals or entities, such as a spouse who is a U.S. citizen or a nonprofit organization. Estate planning can be complicated, and I would strongly advise that if an individual have an estate that have assets over $12.06 million, it may be prudent for the investment advisor or financial planner and their clients to work with an estate planning attorney to ensure all exemptions are taken advantage of and correct process is taken to pass on their financial legacy. There are still many types of taxation, and there is a difference between personal and business taxes. I have covered most types of taxes that is instrumental in tax planning. The rest, I will leave it up to your tax experts. Now, let's take a look at understanding how we can use this knowledge to do your tax planning. Tax strategies are about paying what you owe while taking advantage of all available resources to minimize the tax bill. There are many options when it comes to this, but first, we have to have an understanding of a few of these strategies. So let's talk about tax deductible. Tax deductible is a strategy where you can choose products that allow you to take your investment contribution and deduct from your earning to lower your taxable income. With all the tax terminology, it can be very confusing, so the best way to explain this is in an illustration. Take $100,000 annual income as an example. At a 30% income tax bracket, your tax amount would be $30,000. Let's say that you invest $20,000 in a tax-deductible product. That $20,000 gets to be taken out of the $100,000, leaving $80,000 as taxable income. At a 30% income tax bracket, your tax amount is now reduced to $24,000 because of this deduction, or a saving of $6,000. Here again, taking into account these savings over multiple years, the number can be substantial. Just like the title, is a strategy where you owe tax, but instead of paying for it now, you defer and pay it later. Of course, this is not an option that you get to choose at will, but rather a condition that is allowed under specific circumstances. Understanding these options can save and gain tens of thousands of dollars, or maybe even more for some high-income earners. The philosophy behind deferring taxes is so that you can retain that money to hopefully invest and grow it for your future. Let's take an example. If you have $10,000 and have to pay 30% in taxes, you would only have $7,000 to invest. Taking a simple compound approach, at 10% annual return, you would have $700 at the end of the year. On the other hand, if that tax is deferred and you get to invest all $10,000, at 10% annual return, you would earn $1,000 at the end of the year. Now, Add that $1,000 to the initial $10,000 and repeat that process. Can you see how the difference over the long run would be substantial? Here is an illustration that compares the $10,000 annual contribution tax deferred versus taxable. With return over a 20-year period, can you see why it is prudent to look into a product that allows you to take advantage of this option? If tax defer is good, then tax-free is better. Why? Because you not only get to defer all your taxes, you get to keep it without ever paying a dime in tax. Too good to be true? I would understand why you would be skeptical. There are very few products that would offer this option, but it does exist. Take a look at the same illustration again. Let's say you defer your tax on the $10,000 annual contribution, and 20 years later, your account is now at $640,025. If this is only a tax-deferred account and you are at a 30% tax bracket, you will now have to pay Uncle Sam $192,007, and your take-home amount will be $448,018. Not so shabby. However, if your money was invested in a tax-free account, you will be able to keep the total amount of $640,025. Can you see why it is important to not only pay attention to your rate of return, but also your tax strategies so you can keep more money in your pocket? These are 3 basic strategies that can be used to maximize tax savings in your investment vehicles. Depending on the products, more than one of these strategies are part of the options. Look for my segment on tax-qualified products to learn about these options.